The 2 and 20 structure is a common fee arrangement in the investing world. Today we're going to break down how it works, where it's applied, and how to avoid it to build wealth on your personal finance journey. For those of you new here, my name is Courtney, and this is my channel where I talk about all things investing and personal finance. If you haven't done so already, I would be so appreciative if you hit that subscribe button down below so you never miss whenever I upload a new video to the channel. So let's dive into it. As many of you know, I'm a big fan of index funds and ETFs. So I try and avoid the 2 and 20 structure as much as possible. And hopefully the example I have towards the end of this video will show you why. The 2 and 20 structure is a common fee structure used by hedge funds to pay for the service of actively managing your money. Actively managing means that the hedge fund is constantly buying and selling shares of stocks, trying to beat the market, as opposed to index funds that are passive and track an index and typically don't charge high fees. So for the 2 and 20 rule, the 2 stands for 2%, which is the flat percentage that the hedge fund managers will charge you for all the money that you have in that fund. For example, say that you have $10,000 invested in this fund. You'll be charged $200, which is 2% of your entire investment. This might not seem like a lot, but this really adds up over time. Not to mention, if the fund does poorly and doesn't go up in value, you're still on the hook for paying that 2%, which can really feel like rubbing salt in an open financial wound. The 20 portion of the 2 and 20 rule stands for 20%, which is the performance fee. This 20% performance fee is the cut of your profits that the hedge fund managers are going to take from your investments. This fee is only activated if they pass the success benchmarks that are outlined in the fund, and this varies from fund to fund. For convenience sake, let's take that $10,000 investment from the last example. And let's say this grew 20% or $2,000 within the same year. The fund is going to charge you 20% of your profits. So 20% of this 20% that you made on the investment is going to be $400, which is what they're going to keep for themselves. So at the end of the day, you only realize a $1,600 profit after you take into account that 20% fee. When you factor in both sides of the 2 and 20 rule, in this example where you earned $2,000 from this investment, you only get to keep $1,200 of this. The fund managers are going to swoop in and take $800 for themselves. These high fees are why many choose to stray away from these actively managed funds and instead go towards low-cost index fund options that don't have these high fee structures. For example, VTSAX, the Vanguard Total Stock Market option, only charges you a 0.04% fee. Think about it, that's less than 1/2 of 1% to manage this fund, which is much lower than that 20% fee charged by these actively managed funds. Business Insider's 2020 report stated that only 10% of actively managed funds tend to beat the market over a 15-year period. This really shows that these low-cost index funds are going to be the best way to build wealth over a long period of time, and you're not going to have to deal with this annoying high 2 and 20 fee structure. That's all I have for you today. If you enjoyed this video, please be sure to like this video and hit the subscribe button to see more content from this channel in the future. Thank you all so much for watching. I hope you all are having a wonderful day, and I will see you in the next video. Bye.